Thank you all for joining us this afternoon and Happy New Year. We hope that 2025 is off to a great start for all of you. Myself and my partners, Don Ledoux and Aaron Peabody, will be walking you through the presentation today. For the first Town Hall of 2025, we are drawing inspiration from classic TV game shows. We are using the game shows to talk through how we see the economy and financial markets unfolding for 2025. The million-dollar question is, can the recent momentum we have seen in the economy and financial markets continue? Here are the 10 investment themes we are going to discuss today, each paired with a famous game show. First, we're going to start with optimism overload. And there has been an incredible uplift in confidence over the last few months, and in particular since the election. What has been particularly interesting is that it has been pretty broad-based. In fact, if you look at small business confidence, you have seen the largest single-month increase in confidence since 1980. When you look at large businesses, and for that we look at CEO confidence is at the highest level it's been at for 2.5 years. For consumer confidence and what they expect the economy to do going forward, it's at its highest level it's been at in 3 years. And then investor confidence, those thinking that the equity markets will rise over the next 12 months, that has soared to an all-time record high. Now, is some of this political? Sure, likely, as there tends to be an increased hope whenever there is a new administration coming into the office. Similarly, if you think about a game show, there's always a lot of high expectations for the contestants at the beginning of a show. How many times have you watched Family Feud on your couch and said, those answers would actually be pretty easy? It is always different than if you were actually playing the game. When you look at how optimistic investors are today, these are the headlines they might expect to unfold over the next few months. For example, they are looking for a resolution to the Russia-Ukraine war and Israel war. If that happens, that likely takes energy and gasoline prices lower, and that in turn helps with consumer spending. They expect the newly created DOGE will help cut costs so that the budget deficit improves dramatically. When it comes to tariffs, they think they will only be used as a negotiation tool and that most of them will not go into effect. That instead, countries will give us more favorable trade deals. When it comes to taxes, not only do they expect the 2017 tax cuts to be expended, but they are also looking for tax cuts in general. Now, some of these may potentially come to fruition. However, two things come to mind. First, if they do happen, it is probably already priced into the market. And second, and likely even more important, if we get some negative headlines over the next few months, that likely leads to increased volatility. Now, what are some of the potential headlines that could lead to that volatility? What if some news comes out that AI investments started to slow down? That could slow these markets. Remember that Congress is going to be very contentious. The Republicans have a razor-thin margin in the House. There's a lot to do, and with a thin majority, that might be difficult. If we do have tariffs and that leads to inflation, that could lead to some volatility. And while the consumer has been very resilient, will there be spending fatigue that starts to show up? We have to be mindful of these things to not get overly optimistic. When we look at the over-optimism that is out there currently, that is one of the bigger risks to the markets. Many successful investors have cautioned against the danger of over-optimism and herd mentality, warning people that these dynamics can often lead to costly mistakes. So if we were playing a game of Family Feud, and this is the question that came up, name a famous investment quote that discusses the impact of over-optimism on the equity markets, these would likely be the top 5 answers. Number 5, from the well-known value investor Benjamin Graham, the intelligent investor is a realist who sells to optimists and buys from pessimists. Number 4, Rob Arnott says, in investing, what is comfortable is rarely profitable. And there's a lot of complacency building in these markets, and equity allocations are at very high levels. Number 3, Warren Buffett says, be fearful when others are greedy and greedy only when others are fearful. Number 2, Sir John Templeton. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And when you look at the cycle we are in right now, we are really getting to that optimistic view. And number 1, this isn't necessarily from an investor, it's actually a general. General George Patton said, if everybody is thinking alike, then somebody isn't thinking. That is really the job of our investment strategy team. We don't want to just go with the herd mentality. We want to be doing our research and look below the surface to understand what is really going on. Now, these quotes aren't meant to scare you about the upcoming year. However, we do think we need to dial back our expectation of the markets going forward after 2 fantastic years in 2023 and in 2024. Our next theme, the economy. We're going to use the game Deal or No Deal. If you're familiar with the game, the least valuable prices are on the left-hand side, and they range in the game from a penny to $1,000. And the more valuable prices on the right-hand side, and they range on the game from $10,000 to $1 million. What we've done here is set up the same outcomes, but put in potential economic conditions. A recession being the worst case scenario on the top left, and the most valuable outcome on the bottom right, that the expansion continues. The good news for the economy is that the larger risks, the risks on the left-hand side, have started to come off the board. We don't see negative job growth going forward. Job growth continues to have momentum. Also, wages continue to grow at a healthy clip. When you look at a recession, we feel that has been taken off the board. And when you look at the dynamics of the US economy, the consumer, business spending, or government spending, it continues to be positive. Now, when you look at the risk of inflation going back up to 5%, we feel that's highly unlikely. Now, while it might be slow to get back to 2%, and 2.5% might be the Fed's new target, we would be surprised if we saw inflation back at 5%. A weak consumer. We think that has also been taken off the board, as MasterCard suggests over the holiday shopping season, the consumers increased their spending by almost 4% year over year. The consumer continues to be resilient. The point is that a lot of the risks on the left have been taken off the table. There are a few that still remain, but by and large, the good cases for the economy on the right continue to remain. Raymond James' forecast for 2025 GDP growth is at 2.4%. The trajectory of that growth is likely to be very stable, and we could see the economy pick up some momentum at the back half of 2025. Now, what is going to drive economic growth over the next year? First, continued healthy consumer spending. That makes up 70% of the US economy. Continued benefit from the reindustrialization of the US economy, where the US government is incentivizing companies to bring back their manufacturing to the United States. AI investment will likely continue to be a driver of business spending. When you look at business surveys, AI investment continues to be a top priority. Deregulation should be a tailwind for growth. Streamlining the permitting process, reducing compliance costs, all of that deregulation should help spur growth. And the Fed likely continues to do enough to ensure this economy stays expansionary. They will likely be slower to lower rates than we initially thought, but still on a path of easing. Our next theme, the Fed and monetary policy. And for this theme, we've chosen the game, the newlywed game. The reason for that is that the Fed has a dual mandate, keeping inflation contained and maintaining full employment. Now, while this is not a new dual mandate, since COVID, it feels like the dual mandates are newlyweds. And the important thing, like the newlywed game, this dual mandate needs to live in coordination so that the Fed can cut rates and maintain this current expansion. If energy prices fall and retailers continue to promote discounts and the dollar continues to strengthen, all that could support lower inflation. And lastly, hopefully shelter prices will start to retreat as well. The big wild card is the potential impact of tariffs. Now, we believe these risks are overblown. We are in the camp that the tariffs will be targeted and not near the level that has been talked about. In isolation, tariffs can be inflationary. However, there are other offsetting policies that can take inflationary pressures lower. For example, the energy policy, if the US continues to produce more energy, that could reduce the cost of oil and could bring inflation lower. The strength in the dollar we have seen since the election. This means when you buy things from overseas, it is less expensive and you can absorb some uptick in costs if there are tariffs. When we had Trump 1.0 and we had the first round of tariffs, you did see a small blip higher in inflation when those tariffs went into effect. However, by 2019, inflation was back down below 2%. So it was a small and temporary uptick in inflation. Job creation should continue slower than 2024, but still grow at a healthy pace, and unemployment should remain pretty steady through the end of the year. We believe the Fed will cut 2 more times in 2025, which will get the Fed funds rate to 4%. We do think that the Fed likely pauses at their next meeting in January. Now, it is more important to focus on the outcome of the Fed's actions rather than the number of cuts they deliver. The more important thing is what they deliver. Now, Aaron Peabody is going to take over from here, talking through fixed income.
Thanks, Vanessa. And as we jump into fixed income, let's play the game Jeopardy. And as we know with Jeopardy, we start with the answer, and it really comes down to asking the right questions. So let's jump into some of the questions that we're going to have within the fixed income space on the next slide here. The questions then become, what's the likelihood that we have a higher rate than we're sitting at today, a lower rate that we're sitting at today, or do we stay in this same range band that we've been at? Right now, the 10-year Treasury, as of close of today, was just shy of 4.8%. The price target at the end of the year right now on the 10-year Treasury is at about 4.5%. Now, interest rates has been a really, really challenging topic over the last 6 months, 9 months, obviously 2 or 3 years. If we think back to the challenges of 2022, and people were really feeling an economic hit to their portfolio, both on the stock side and on the bond side, we had this historic run in interest rates. So what could potentially drive rates higher? Upside tariff-driven inflation, like Vanessa mentioned earlier, upside risk to growth, and potentially increased government spending. So if our budget continues to grow and grow and grow, our deficit continues to grow and grow and grow, there needs to be a demand for those additional bonds that are entering the market, which starts to drive yields higher. Now, on the flip side, what can help drive yields even lower than where they are today? Things like quantitative tightening stopping, stronger dollar demand, or a reinstatement of the debt ceiling and increased volatility. So if the economy starts to get a bit softer, then the Federal Reserve likely steps in and tries to reduce rates, which actually helps spur economic growth. Now, as we look at this target at 4.5%, it's really important to remember that interest rates have been a very, very volatile topic over the last, like I mentioned, 6 months to the last year. If we looked back just before the election, so not that long ago, 3-4 months ago, the expectation was that we were going to see 5 to 6 rate cuts in 2025. As we sit here today, we got a little softer PPI inflation, which was positive this morning. The expectation at this point is actually 0 to 2 rate cuts in 2025. So just in a 3 or 4 month period, the overall market expectations have moved from 5 to 6 rate cuts in 2025 to just 0 to 2, somewhere in that much more moderate cut in short-term rates. As we've talked about in many of these presentations in the past, though, again, the Federal Reserve controls the short end of the curve. The market adjusts the 1, 3, 5, 10, 30-year money based on those short-term rates on things like inflation expectations, debt levels, deficit spending, those types of things. Now let's look on the next slide at some of the probabilities around these rate numbers. And this is where we always want to caution any prediction or any data as a decision-making mechanism, but it again shouldn't be taken as a definitive, this is where rates are likely to be. As we can see here, we got a 4.5% base case on the 10-year Treasury at the end of the year. That, though, from a probability standpoint, is sitting at about 60%, meaning we still have a 20% probability that inflation continues to rise. There's some pressure on interest rates. We start to get the 10-year actually north of 5%, which we saw within the last 12 months. There's also a 20% probability that we get some softer economic times. The Fed continues to cut rates, and we have about a 20% probability that we end up under 4% in the 10-year numbers. What this is really driving in a lot of the investment decisions within the portfolio is a desire for us to be on the much shorter end of the curve. That gives you less susceptibility to movements up and down in interest rates. Right now, we went from an inverted yield curve where short-term money was actually paying more than long-term money to a very flat yield curve. You're effectively getting the same amount of interest, whether that's 3-month money, 5-year money, 10-year money, you're within 30 basis point delta of a rate of return. So from that perspective, right now, we're leaning into the shorter end of the curve just to protect ourselves more because there is some uncertainty on where rates moving forward. A lot will depend on what happens, obviously, next week as Trump steps into office, and then what policies does he actually put into action versus what policies were just, campaign rhetoric and things that he's actually not able to accomplish. Now let's move into the equity markets. And the equity markets, we're going to play that game of price is right, or PE ratios. What's the right price for us to be paying for stocks? Now, as we start to drive through some of the data, we want to look at the benefits that we've seen from the stock market here for the last 2 years. So we've had some really nice growth within the stock market, back-to-back years of over 20% rates of return. So good rates of return for the S&P 500, the 500 biggest companies here in the US. Now, if we look at what's actually driving that 25% annualized growth, so about 50% growth in price return, you see there in that the bar chart, about 10% of that's coming from earnings per share growth, so profitability growth. And then about 40% of that's coming from PE expansion, meaning people are willing to pay more, higher price to earnings ratios for the same amount of profitability from those companies. So that's really what's driven this market movement over the last couple of years. Our economy's been growing, but not nearly at the rate that the overall stock market's been growing. And so as investors, and we continue to look at this and monitor this, the question then comes back to, again, what is the right price to pay for stocks moving forward? So let's jump to the next slide here. What this is looking at is the overall consensus EPS, or earnings per share, for the S&P 500 at $270. If we take a PE ratio of 23.5, that leaves us with an S&P 500 target of just shy of 6,400 at the end of 2025, which is just about 10% from where we are right now. I think what's really important to remember, because we really did not experience this in 2023, in a normal stock market environment, you get 3 to 4, 5% pullbacks per year, meaning the market may be point to point from January 1st to December 31st, up 10% or 8% or 15%, wherever it ends up throughout that year. But during that year, you tend to get this volatility, which creates these pullbacks, again, 3 to 4 times. We really saw almost no pullbacks in the markets. Last year, we had a quick Japanese yen trade unwind that happened that spurred some volatility back in the summer months. But other than that, we really had no volatility, which is kind of unheard of for an election year. But just a reminder for us as investors, it is normal to have volatility. It's not normal for us to just have a straight line forward. The markets don't work like that. Again, we expect markets to continue to grow, but it's likely that we see a little bit more choppiness in 2025 than we experienced in 2024, even though honestly we expected to see more choppiness in 2024 than we got. But again, the earnings have got to keep up and continue to grow to continue to get expansion in the stock market, because we're already paying on the higher end of those price to earnings multiples. Now we look at, just as we did in the fixed income space, at kind of the bull market, the base case and the bear market. So base case, like we just mentioned, S&P lands at about 63.75 by the end of the year, about a 50% chance that we end up there given where we're at right now. That's going to be relying on an economic soft landing. That's the expectation of 2 Fed rate cuts in 2025, slight margin expansion from the earnings, price to earnings ratios that people are willing to pay for companies, and disinflation continues. So we continue to slow down the rate of inflation moving forward. About a 30% probability that we outpace that, and that we've got an S&P target of 7,000. That's going to be relying on economic reacceleration, margin expansion, and sentiment continuing to stay elevated, with hopefully some favorable regulatory and tax. So the flip side that we're dealing with on the bear side, where people are concerned about tariffs, potentially inflation, a weakening credit market, and the strengthening dollar, the hope is the flip side on the other end of that is reduced regulation, which allows us to see additional profitability from companies because they're not spending quite so much money on some of the regulatory issues. And again, that can create further expansion within the markets. Now, if we're invested in the markets, now let's talk about the equity sectors. And we'll use the game of Are You Smarter Than a Fifth Grader to set the backdrop for this. The three sectors that we are most interested in or most excited about for 2025 is technology. Is there a continued advancement within AI and just technology in general? We've obviously seen a big boom in that in the last couple of years. It's slowed down some of the momentum recently, which is probably a healthy thing for the overall markets. But there's no question that technology is continuing to advance at a hyper rate, and it's changing the way that all businesses are run, creating additional opportunities for that earnings to increase, which allows, again, the markets to increase. Industrial sector, we think about that as a more kind of the reliable all-around type of a student if we're talking about the Are You Smarter Than a Fifth Grader? Continue to benefit from government spending, the AI build out that's going on, right? We need to build a lot of infrastructure to actually house and utilize this AI technology, and the electrification or re-electrification of our power system. The big challenge for AI long term is the ability to actually power all of this technology that's constantly running data through it. Second after second, you need the industrial, you need the infrastructure in place to go do that. The kind of underdog student we would look at is the healthcare sector, which really has hidden potential. It's been a challenged asset class here over the last 12 months. It does have very attractive valuation points, though, if you look at where it's at historically. One of the big challenges healthcare is experiencing, though, is, again, with this change in administration, what is actually going to happen within the healthcare space? You get some of the politicians like an RFK that have been pretty vocal about going after healthcare companies, pharmaceuticals. That's impacted some of the valuations. But as that starts to work itself out, we can't get away from the fact that we have an aging population that is going to need more care over time. And that healthcare system is there to create some profitability to drive that. Now, as we continue through kind of some of the fundamentals there, again, when we're looking at stronger earnings growth, so companies that are profitable, how are we growing that profitability? The infotech, healthcare, and industrial space is really leading the crew on that. And so again, that's why we're leaning into those sectors within the portfolio, both from a sector perspective and then also underneath the hood in a lot of the mutual funds that you guys own, a greater allocation toward tech, industrials, and the healthcare sector. So I'll kick it over to Don to continue the presentation on the mid-cap space.
Thanks, Aaron. I greatly appreciate it. And I'm going to continue on with mid-cap equities along with the Hollywood squares. And for us older people, it is kind of fun to reminisce about some of these games over the past several decades. Mid-cap equities have not done overly well in 23 and 24 relative to their large cap and small cap peers. So Raymond James feels that with the new administration, with the balance sheets good, with interest rates relatively stable, that now is the time for mid-caps to shine. And on the next slide, it'll give you a kind of a Hollywood Squares setup there, showing how large cap has expanded their price to earnings ratio, mid-cap's been in the middle, and small cap is a little bit higher. So there's some good earnings in mid-cap. The balance sheets are good. They're less exposed to tariff issues. And on large part, the companies are profitable. About 97% of mid-cap companies in an index are profitable, whereas in the small cap, about 30%, believe it or not, are unprofitable. primarily due to heavy biotech exposure. So mid-cap is where we're taking a look, and if the new administration's policies seem to support that, then we're going to give it a look in our client portfolios and possibly switch up some of the allocation to mid-caps. On the next slide, the focus is international equities. And for those of you that have been on these calls with us or town halls with us for quite a while, we've talked about international equities and how we have been purposely underexposed to international equities for about 8.5, 9 years right now. Not that we don't like them, but when we make allocations to various asset classes, we're looking long-term, trying to figure out where to properly allocate client monies. And not that the US is an angel per se, but going from 15 trillion of debt in the early 2010s to 36 trillion of debt now, we've been spending a lot of money, and that money has driven growth in the US. We'll talk about that a little bit further. So it continues to outpace international markets. And on the slide here, you'll see that Raymond James is forecasting strong economic growth in the US, along with on the right-hand side, the earnings growth is going to continue to outpace, and that's what we're focused on. As long as the US is spending and investing, then the US market should continue to outperform, which is why, again, across client portfolios, we are and have been extremely underweighted in international markets. Someday it may turn, but for, again, in 25, we're sticking with what has worked for the past 8 or 9 years. On the next slide, it shows from a bubble perspective. In the center there, it'll show that on companies 50 billion in market cap and over, taking all those companies, the US has a $28.3 trillion market cap, and Europe is at 1.7. Now, that does not mean that Europe does not have some good companies, and they do, but from indexes as a whole, and even from a money manager perspective, it has been the right place to be in the US. And until we either reduce spending or do things that lower the growth rate in US spending, we're going to stick with that, and we'll always keep our eyes open to international, but this is the best place to be at the moment. On the next slide, it's another way of showing how the US dominates the market by the font size of all these various companies and their associated market cap given the font size compared to the international markets in blue there on the lower right-hand side and a few other places inside there. But again, Microsoft, Apple, NVIDIA, all well over 3 trillion. Apple almost hit 4 trillion the other day. Amazon north of 2 trillion. There are some sizable companies. And what our spending has done, even though there's some eventual downside to it, it has allowed US companies to dominate technology, dominate various markets by the spending, which has allowed them to then expand internationally. So when we have a US focus and less international, please keep in mind that about 40% of the S&P 500 earnings comes from these large companies and their international markets. So we're basically trusting the Apples and Microsoft and NVIDIAs to do well in the US, be profitable and smart internationally versus trying to go find fast-growing international companies, because again, these companies here flat out dominate their markets. On the next slide, selectivity and risk management. It's always a function for us of figuring out how do we want to allocate client portfolios and what kind of risk management do we have in place. And so we'll talk about that on the next slide here. This slide will show you on the left-hand side, talks about interest rates. When we have bond portfolios in client accounts, and if we get concerned about risk quality, the blue circle there is encircling high credit, investment grade, municipals, treasuries, things that have extremely low default rates, maybe 1% or less. Those are the areas where we have most of our clients' money. And then there is some spread out as we go out that to emerging market debt or US high yield. You expect to be, and you are paid a higher rate of return for the risk of being paid back. But we never want to own too much of that, especially in uncertain times, because whether it's 2001, 2008, there are times when the high yield or emerging market debt, the rate of return that you get is that you're still running at a loss for the return on the investment. So we would be very conscious of that. To the right-hand side, it is circled the S&P and mid-cap. It's Raymond James' belief that S&P 500, for its historical rate of return and the standard deviation of risk, is going to do well. And they've encircled mid-cap like we talked about a few slides back. They think those two indexes are going to do well in 2025, given the current momentum of the economy, some talked about legislation from the new administration, but we're definitely in a wait and see mode to see what happens in the coming months. But right now, that's our focus on that. On the next slide, it talks about in the world, what was the best market and what was the worst market. So the best was the US, S&P 500 up 25%. Latin America, down in Brazil and stuff, was the worst at minus 26%. Then when you look at a region that had the broadest disparity, you have Italy in Europe plus 13% and Portugal down 25%. For countries that are more or less pretty close to each other, that's a pretty disparate number in there and tough to manage through when you have one country X miles away at 13 and then Portugal minus 25. Inside the US, the best sector and the worst sector, the best sector was up 40%. That was communication services companies, and materials was basically flat. So that was the broadest spectrum of returns in asset classes inside the US, communication services and or sector and materials. And then in the industry, take a step below that, entertainment was up 48% and the media was minus 7. So again, trying to stay large cap, trying to stay profitable, trying to stay focused on good momentum, and it worked out well for our clients in general. On the next slide, we're going on to the game of Wheel of Fortune and Who Wants to Be a Millionaire. But the slide we're going to talk about really is focused on the next slide here is on Who Wants to Be a Millionaire. And why is asset allocation so important? Well, being invested is the first rule. Stay invested, you can participate in the markets, and on average, you should do good. The next part is for us to figure out the asset allocation, which I touched on, and where Vanessa, Aaron, and I and our team spend a lot of time on is where should client money be allocated, and not just for a month or 3 months, but where should that money be allocated for an extended period of time based on the policies of various countries. And that's part of our strategic decision-making. When we work on our portfolios, we talk every single week about those, and we'll do more so with the upcoming changes anticipated from the new administration. Diversification, you never want to make one bet. We're not smart enough to pick the sole winning sector each and every year. You've all probably seen the chart that has various returns over various sectors, and over time they ebb and flow and all have their chance at being number one on a given year. We are diversified across the US. We do own a little bit of international, and for various reasons, like I mentioned, that could change over time. We're always on top of it, but our clients are broadly diversified. From a risk management perspective, we stay broadly diversified. We primarily stay with segments that are profitable, growing, good debt ratios, and have a bright future versus trying to over allocate or get too concentrated in a certain position because the latest high flyer, those don't always end well. And our clients need to know that there's no do-over, that they're retired. We promise we can work on their portfolios and they're planning to provide a great retirement. That's a function of managing risk. And then lastly, our clients do a great job because there's lots of unpredictability in the markets. We get these ebb and flows. To Aaron's point, we get the 3 or 4 or 5% declines every year, which are never fun, but the market tends to find a way to bounce back because on average, the economy is growing and therefore your portfolio is going to grow as well. And that requires patience. We're due for another little bump. We had a bump in 22 that was not fun. 23 and 24 were great. 25, we'll have to wait and see how that plays out, but there will be some unpredictability and we're going to need some patience to get through this and see where the world takes us. So with that, we always appreciate your time. Thank you for joining us today. We are recording this. We're happy to send out a link for people that want to revisit this. And we look forward to talking to you all again very soon. And thanks again for joining us today.